Accrual accounting. What is it? What's the difference between cash and accrual accounting? And what does accrual accounting mean for your business? Today, I'll be helping you understand all about accrual accounting and the pros and cons versus cash accounting. Are you ready? Let's get started. Hi, I'm Laura, a finance manager here at Sleek, an all-inclusive platform that's dedicated to helping small business owners like you manage your business needs. There are two methods of accounting. One is cash accounting, where transactions are recorded at the same time that cash is received or paid. This is the simplest method. The second is accrual accounting, where transactions are recorded at the time that revenue is earned and expenses are incurred. The main difference between these two methods is in the timing at which these transactions are recorded. With all that, you might well be thinking, well, since cash accounting sounds so much simpler, why should I bother understanding accrual accounting? Well, the first reason is, believe it or not, using the accrual method to account for your transactions actually makes your financial statements easier to understand at the end of the day and gives a more accurate picture of profitability and financial position at any point in time. It does involve some accounting expertise to get it right, but accounting software makes it pretty easy to manage these days. Secondly, and more importantly, the accrual basis of accounting is advocated under generally accepted accounting principles and international financial reporting standards. So this often makes it mandatory for most businesses, especially if you're a large business. In some instances, very small businesses will have the option to choose between the two methods. Let's go back to the shoemaker business that we looked at when we reviewed the statement of profit and loss in our previous episode. So here's the scenario. Let's call our shoemaker Bruce. He has 50 pairs of shoes that is required to make and deliver to a retailer by the end of July. He will hand the retailer an invoice for $5,000 at the same time, stating that they have 7 days to pay. Bruce had bought all the shoe materials and made the shoes back in June for a total cost of $3,000. Basic maths is already telling us that he's made a profit of $2,000 on the making of these shoes. Under cash accounting, the expenses for the shoes would have been recorded back in June when the materials were bought. The revenue would be recorded in August when the client pays their invoice 7 days after it was issued. Under accrual accounting, the revenue will be recognized in July because that's when the goods were physically delivered or the revenue was earned. The cost to make the shoes is only incurred when those shoes have earned revenue for the business, so the cost will be recorded in July too. This is what's called the matching principle of accrual accounting. That is, revenue and expenses that are related to each other are matched in the profit and loss. As we can see, if Bruce were to sit down with his cup of tea at the end of the month and review June's performance under cash accounting, he'd have a shock seeing a loss of $3,000. However, in August, he would see a profit of $5,000 and think that business is going great again. With cash accounting, poor Bruce would be going on a roller coaster of emotions each month. Meanwhile, accrual accounting shows the entire profit in the month where the revenue was earned and the expenses incurred. And this is a far more consistent way to record your profitability. Okay, you still might be saying, Laura, really? These scenarios end up with the same level of profit by August, so I'm still not convinced in going to all that effort. Great thought. However, think about a business with hundreds or thousands of these types of transactions. There would be timing discrepancies all over the place, which would make it almost impossible to have a clear picture of profitability at any one time. Here's a summary of the pros and cons of accrual accounting. Pros. As mentioned, you'd have a clear understanding of profitability at all times, as accrual accounting provides a more even recognition of revenue and expenses over time via the matching principle. You'd also be more aware of your financial position at any point in time because, for example, when you record revenue, you also record that you have the right to receive the associated cash on your balance sheet as an accounts receivable asset. The cons. Accrual accounting is definitely not as simple as cash accounting. It requires you to make a judgment on when revenue is earned and expenses are incurred and make entries in the balance sheet. It's also not easy to track cash flow. Cash accounting largely aligns profits with your cash, which allows a business to better track cash. Under accrual accounting, you need to pay close attention to your balance sheet and statement of cash flows in order to understand your cash position. Don't be afraid to reach out to trusted professionals like myself to guide you through how accrual accounting applies to your business. Congratulations on making it to the end of another video. I'm so proud of you for learning a new concept to further your business journey today. If you liked this episode, subscribe, give this video a thumbs up, and don't forget to leave any questions down in the comments section below. From your head nerd accountant, this is Laura, signing out.